Silver just plunged from 91 to 85 in a matter of hours. $6 erased in a single session. If you're watching your portfolio right now, your first instinct might be panic. It feels sudden. It feels violent. It feels like the rally just died. But before you make a decision you can't undo, pause, because this drop didn't come out of nowhere. And it doesn't mean what most people think it means. What if this isn't the end of the move, but a reset? What if the crash is part of a pattern, and the real opportunity is just beginning? Every time silver pulls back sharply, the same emotional cycle begins. Price falls fast. Headlines turn negative. Social media fills with "I told you so" comments. Traders who bought near the highs start questioning their decisions. Long-term holders begin to doubt the thesis. And this drop felt violent. $6 in one day is not normal behavior for a stable commodity, especially not when gold, its closest macro partner, was moving in the opposite direction. When two assets that historically move together suddenly diverge, something deeper is happening. The real issue isn't the $6 drop. The real issue is uncertainty. Why now? Why at the end of the month? Why during futures expiration? Why does this keep happening repeatedly? Because this isn't the first time. Go back to December, silver was trading near 83. Then within 48 hours, it collapsed to 70. No major news, no mine shutdowns, no collapse in industrial demand, just a sharp, aggressive sell-off right before month end. Then January came. Silver rallied aggressively. It pushed to new highs, exploded higher. And again, right before the calendar flipped, it crashed. This time, even more dramatically. Panic returned. People swore off silver forever. And then February arrived. Recovery, strength, momentum. Now here we are again. Final day of the month. Another sharp drop. 3 consecutive months, 3 end-of-month declines, all during futures expiration windows. Once might be coincidence, twice is suspicious. 3 times at the exact same phase of the cycle, that's structure. And here's why that matters. At the end of every futures cycle, contracts must be settled. Traders either roll them forward or demand physical delivery. When more participants demand actual metal instead of paper rollover, the system faces pressure because futures markets are heavily leveraged. Paper contracts far exceed the amount of physical metal available for immediate delivery. If too many participants request real silver at the same time, the exchange faces a logistical problem. Not necessarily a shortage, but a matching problem. For every buyer demanding metal, there must be a seller willing and able to deliver it. When those numbers don't align, volatility increases. That's the real risk behind these sudden drops. It's not collapsing demand, it's stress inside the delivery system. And that's where things get interesting. Last night, I started digging into the mechanics behind this move. Not just price charts, not just technical indicators. I went into the settlement data, the vault numbers, the delivery notices, and what I found stopped me cold. Registered silver inventories, the metal officially available for delivery, have been shrinking consistently. Over recent weeks, tens of millions of ounces have left exchange vaults. That's not speculation, that's recorded data. At the same time, open interest going into expiration has been unusually elevated. More contracts remaining open than typical for this phase of the cycle. That means more potential delivery requests. Now think about that combination carefully. Falling registered supply, elevated contract open interest, expiration approaching. Pressure builds quietly. Most retail traders never see it. They only see price. But beneath the surface, the matching engine is tightening. And then something else happened. Trading was halted across metals markets. Not just silver, not just gold. Multiple commodities paused mid-session. The official explanation? Technical issues. Maybe, but timing matters. It happened during one of the most sensitive windows of the month, just before a major notice day. When trading resumes after a halt, the order book can shift dramatically. Buyers disappear. Sellers press aggressively. Momentum changes. And that's exactly what we saw. Before the halt, silver was already slipping. After the halt, it accelerated lower. Meanwhile, gold recovered and moved higher. That divergence is rare. Historically, gold and silver correlation sits high. They typically move in tandem. When one rallies and the other drops sharply on the same macro day, that's abnormal behavior. So now we have 3 months of end-cycle drops, shrinking registered silver inventories, elevated open interest into expiration, a mid-session halt during delivery week, gold and silver diverging individually, each event could be dismissed. Together, they form a pattern. And when patterns repeat cleanly, you don't ignore them, you study who benefits. Because in markets, price moves are rarely about emotion, they're about incentives. Let's slow this down and walk through how this system actually works. The futures market is built on contracts. When you buy a silver futures contract, you are agreeing to either take delivery of silver at expiration or roll that contract before delivery begins. Most traders roll, very few stand for delivery, but when more participants than usual decide they want real metal, not paper exposure, the system must respond. Here is the structural reality. The amount of paper silver contracts outstanding at any time far exceeds the physical silver sitting in registered vaults ready for immediate delivery. That doesn't mean fraud. It means leverage. Futures markets are designed for hedging and speculation, not for everyone to demand physical settlement simultaneously. So what happens if delivery requests increase sharply? The exchange and clearing participants begin matching buyers with sellers. If there aren't enough willing physical sellers at current prices, pressure builds. Sometimes that pressure resolves naturally. Sellers step in at slightly higher prices. But if velocity, the speed of price movement, accelerates too quickly, risk increases, and this is the key insight. It's not necessarily the level of silver's price that creates stress. It's the speed of the move. If silver climbs from 80 to 90 gradually over months, the system adjusts smoothly. Contracts roll forward. Deliveries occur at manageable levels. But if silver jumps $6 in a few sessions, heading into expiration, more traders may choose to lock in gains by standing for delivery. Others may demand metal anticipating further price spikes. Suddenly, the ratio between paper claims and available physical inventory becomes uncomfortable. The exchange's mandate is to maintain orderly markets. When volatility threatens that order, tools exist. Temporary trading halts, margin requirement adjustments, liquidity management, contract rollover encouragement. These mechanisms aren't T conspiracies. They're structural safeguards. But their side effects are visible on charts. When margin requirements rise, leveraged traders must either add capital or reduce positions. Many reduce positions. That creates selling pressure. When trading halts occur during volatility, momentum shifts. When participants are encouraged to roll instead of take delivery, immediate buying pressure fades. And once buying momentum slows, sellers dominate short-term price discovery. That's what a cooling event looks like on a chart. It appears as a crash. Now zoom out to the larger context. Over the past 9 months, silver's 50-day moving average has steadily climbed. Every correction has been temporary. Every dip has eventually been absorbed. Meanwhile, industrial demand continues globally. Solar production, electronics, medical applications, these don't shut off because price dips $6. Registered volt inventories have trended downward over time. Whether slowly or quickly, the direction has not reversed meaningfully. Each time silver corrects sharply at month end, a similar recovery follows in the next cycle. December's drop to 70 recovered within weeks. January's violent correction recovered even faster. Now, February shows a smaller drop, only $6 compared to previous double-digit plunges. That's notable. Corrections shrinking in magnitude often signal strengthening underlying demand. In December, fear drove price to 70. In January, fear tried again. In February, buyers stepped in higher, near 85 instead of waiting for 70. The floor appears to be rising. That's what markets do during accumulation phases. Volatility shakes out weak holders. Stronger hands step in. Inventory migrates from short-term traders to longer-term participants. The public narrative focuses on the crash, but institutional participants focus on inventory and positioning. If you were managing large capital and believed silver's long-term supply-demand dynamics favored higher prices, you wouldn't panic at a $6 drop. You'd analyze whether underlying physical conditions changed. Did vault inventories suddenly surge higher? No. Did industrial demand collapse overnight? No. Did macro monetary conditions reverse? No. What changed was price, temporarily. Now consider another dynamic. Psychology compounds volatility. Retail investors often sell into sharp drops due to fear of further losses. That selling adds momentum to an already pressured market. Meanwhile, stronger capital allocates during weakness. This transfer happens repeatedly in commodity cycles. And because silver is thinner and more volatile than gold, these swings appear more dramatic. Gold may move 1%. Silver moves 3 or 4. That's not malfunction. That's characteristic behavior. So when gold rallied modestly while silver dropped, it wasn't proof of collapse. It was a sign that silver faced specific short-term pressure during expiration mechanics, but longer-term structural forces remain intact. And that brings us to the bigger question. If the pattern holds, 3 months of end-cycle weakness followed by recovery, what happens next? History suggests stabilization, then rebound, then potential breakout, especially if the rising floor continues. December low, 70, January low, 70, February low, mid-80s. Higher lows signal accumulation. Markets don't bottom perfectly, they stair-step upward. The question isn't whether volatility disappears. The question is whether underlying supply tightness continues while demand persists. If it does, price eventually reflects it. Short-term cooling events don't invalidate long-term trends. They reset them. And if this was another reset, not a reversal, then what looks like fear today may look like opportunity later. The drop in silver didn't happen because the market suddenly broke. It happened because markets manage risk. Futures trading is built on promises. Contracts represent agreements to deliver or receive metal at a future date. Most participants never intend to take delivery. They roll positions forward, maintaining exposure without handling physical silver. This keeps liquidity high. But at expiration, the system must settle obligations. If more traders request delivery than available sellers can provide, stress emerges, not failure. Stress. Registered inventories, the metal designated for delivery, have been declining over recent periods. That is recorded data. Vault reports show millions of ounces leaving storage. Fewer reserves mean tighter conditions. When conditions tighten, price responds. Volatility increases. Exchanges may implement safeguards to maintain order. Trading pauses. Margin requirements adjust. Participants roll contracts instead of demanding immediate settlement. These mechanisms are not conspiracies, and they are structural tools. Their purpose is stability. However, side effects appear on charts as sharp moves. To the outside observer, it looks like a sudden crash. To the system, it is risk management. Understanding this distinction is crucial. Price movement does not always reflect fundamental collapse. Commodities operate differently from equities. A technology stock can lose value because growth expectations change. A commodity can drop because delivery timing and leverage dynamics shift. Silver's industrial and monetary roles remain intact regardless of short-term fluctuations. Factories continue using it. Solar installations continue requiring it. Medical and electronic applications continue consuming it. Global demand does not pause because a trading session was volatile. Long-term consumption trends persist. Now examine history. In prior months, sharp corrections occurred near expiration cycles. December saw a violent drop followed by recovery. January repeated the pattern with greater intensity. February introduced a smaller correction. Each cycle tested participants. Weak hands exited during declines. Stronger hands accumulated. This transfer of ownership is normal market behavior. It does not signal permanent breakdown. Instead, it reflects the process by which markets find equilibrium. Price searches for levels where buyers and sellers agree. When supply is tight, that equilibrium shifts higher over time. Inventory trends support this view. Registered silver available for delivery has decreased. Open interest into expiration has been elevated. These factors create matching challenges. For every buyer requesting metal, a seller must deliver. If the ratio becomes imbalanced, adjustments occur, price moves, volatility rises, the system adapts. This is why short-term drops must be interpreted carefully. A $6 decline sounds dramatic in headlines, but in context of broader cycles, it represents one data point, not the entire story. Longer trends matter more. Over 9 months, silver's moving averages have trended upward, higher lows have formed, recoveries have followed corrections. That pattern suggests structural demand. It suggests accumulation rather than collapse. Markets rarely reward emotional reaction. They reward patience and analysis. Selling during volatility locks and losses and removes participation in potential rebounds. Holding through uncertainty requires conviction supported by evidence. Vault reports, delivery numbers, industrial consumption, macroeconomic conditions. These factors have not reversed. Price fluctuated, structure remained. That difference is the foundation of informed decision-making. So the revelation is simple. The crash does not invalidate the broader thesis. It challenges short-term assumptions. It tests participants. It reminds us that markets are dynamic systems. They expand and contract. They reward discipline. They punish haste. If the underlying demand story for silver is correct, industrial usage, monetary diversification, and constrained supply, then volatility is part of the journey, not the destination. And if the story is incorrect, reevaluation is appropriate. Data must guide conclusions, not emotion, not headlines. Data. The reveal, therefore, is this. Short-term drops are not definitive verdicts. They are signals within a larger system. Understanding them requires perspective, and perspective reveals opportunity where others see only risk. Now I want to talk directly to you. If you hold silver, how are you feeling after today's drop? Did you watch the red candle and feel the urge to act? That feeling is normal. Humans are wired to avoid loss. When numbers fall, our instincts scream to do something, but markets punish reaction. The real question isn't whether the price moved $6. The real question is why you invested in the first place. Was it short-term speculation, or a longer view about demand and scarcity? If it was short-term, volatility will always feel brutal. If it was long-term, today is just another data point. I'm not telling you to buy or sell. I'm asking you to think. Look beyond the candle, beyond the headline, beyond the noise. Vault inventories are still tightening. Industrial demand hasn't vanished. Historical patterns of recovery remain visible. So what will you do? Panic decisions rarely age well. Patience and information do. Tell me in the comments. Are you buying this dip, waiting for clearer confirmation, or stepping aside for now? There's no right or wrong answer, only informed choices. Markets move, emotions fade, data remains. And the people who succeed over time are the ones who make decisions based on understanding, not fear. Silver dropped $6. That hurts if you were watching your position. It feels like confirmation that something is wrong. But markets don't move in straight lines. They breathe, they correct, they recover. December showed it, January showed it, February is showing it again. Each time the drop came at the end of the month, near expiration. Each time volatility increased, and each time the market stabilized and moved higher afterward. That doesn't guarantee the same outcome now. Nothing in markets is guaranteed, but patterns exist, and patterns deserve attention. Higher lows have formed. Inventory trends remain tight. Industrial demand continues. The long-term structure has not broken. Price is the variable. Structure is the foundation. If you zoom out, the $6 drop is smaller than previous corrections. It signals cooling, not collapse. It tests participants, not the thesis. So what comes next? Possibly consolidation, possibly another dip, possibly stabilization and recovery. No one can predict the exact path. But informed participants focus on data, not panic. They understand cycles. They respect volatility. They make decisions with perspective. If you're holding silver, today is a reminder, patience matters. If you're watching from the sidelines, opportunity often appears when others fear. And if you're unsure, that is okay. Markets will be here tomorrow. Decisions made in calm moments tend to outperform those made in crisis. The loop continues.